Welcome to Magnet Minutes. This is Jordan Kimmel with an update for Tuesday, May 3rd, 2022. And it's a pleasure to bring on a new friend and colleague. It's Rob Isbitts. He's the founder and Chief Investment Strategist at Sungarden Investment Publishing. And hey, Rob, thanks so much for joining us.
Well, thank you, Jordan. This is great. Glad to be with you and looking forward to talking markets.
Good. Well, Rob, we just met fairly recently. We had a really nice conversation. And what's really cool about this conversation is that you and I approach the market very differently. It's important to note that there's lots of ways in this industry. The only thing that's important to me is success and strategies that work. So where I am more of an equity guy, I know you are not only an ETF individual, but you're actually doing something in the bond market right now, which is super, super important. And that's why I really wanted to have you on. So, so let me just share, I've been in the business a long time, as you have. There was something used to be called the 60-40 model, very popular. You had 60% of your equity, 40% in bonds. That's over, and you cannot have 40% in the bond market anymore. So that's kind of a setup for the conversation. But before we get all the way there, Rob, you may just want to share. You have a storied career. You may want to kind of just bring us what Sungarden's really all about.
Sure. So yeah, and thank you. And by the way, you didn't realize it, but if you were in sort of Sungarden's virtual offices, you actually said a curse word without realizing it.
Which was?
60-40.
Good. You know what? Then there's a lot of people still using it, and they'll be out of business fairly soon.
Yeah. I was going to say, if somebody wants to know where I've been as an investor, my journey was started a long time ago. Just Google Isbitts 60-40 portfolio, and you'll see all the things I've been writing about it for the better part of a decade. But the quick story on me, we're both numbers guys, so I'll put it to you this way. So 58 years on Earth, but 42 years ago, when I was 16, my late father, the guy pictured behind me, and also the little note he sent me when I opened my own firm 10 years ago. Carl Isbitts, native of the Bronx and Bronx science, and ironically was Sandy Koufax's college roommate. He and a bunch of his friends
That's cool.
From New York recruited into Cincinnati, and my dad roomed with him for the 1 year he was there. Sandy had bigger things to do, like playing baseball for the Dodgers and on no-hitters. So anyway, 42 years ago, he teaches me charting. I fall in love with it. At the time, we didn't have the computer systems we did. We were doing it by hand. And, it started as kind of a science, became a bit of an art form as time went on. Started my career on Wall Street in 1986. I was a North Jersey kid, fair lawn. And, across my career, I went from the back office to the brokerage business, to the RIA business, to being a partner of an RIA, to being the CIO of about a $3 billion firm at the time, which got much bigger without me, and good for them. But also about 10 years ago, sort of came into my own. My wife and I started our own practice, which was called Sungarden Investment Management. And then 2 years ago at age 56, in 2020, and not really because of COVID, but just sort of synced up with it. I was always a investor like you, but in a financial advisor's clothing. I'm not a CFP, I'm an investment advisor. And now I'm really an investment strategist, signal provider, because 2 years ago, I sold the advisory part of the practice, continued on, at least indirectly, providing model signals to the buyer, and now extending that service, that model signal service, to other advisors through a platform called Tactive Wealth, but also doing a lot of writing and publishing and like I've done for Forbes, US News, and other places over the years. So that was kind of my journey on how I got here. But you know, you can take the boy out of Jersey, but you can't take Jersey out of the boy. And what this boy learned in Jersey was technical analysis of stocks and now ETFs. And to me, it's the end point in after you've done the basic analysis to figure out what you're willing to own at a price. The technicals take over, and I live and breathe them and really try to teach them as well.
Right. So let's go there for a while. And first of all, you Bronx Science, your dad and I share an alumni.
Yeah.
And so it was a great school, probably even better when your dad was there. But I'm a New York guy, and took the D train to Bronx Science, and heck of an education, and kind of led me where I'm going. So let's just talk about this for a minute. I'll let you get a little bit combative, if you will. The old book, I'm sure you read it, Random Walk Down Wall Street, something that I don't believe in, but basically talked about flipping a coin over and over again, and heads or tails, and created a chart based on that, where people wanted to know what was that chart on, because it looked like it was about to break out. And so what Magnet is, Rob, is we combine fundamentals and technicals, and certainly I have all kinds of charting programs open on my computer right now. But there are people who say charts give you an idea what happened, but charting is nonsense. How do you respond to that?
Sure. So when it comes to charting, I liken it to the NFL. I've written a couple of books. I wrote about this in the first book, which was called Wall Street's Bull and How to Bear It, long time ago. So all week you interview NFL players, and they go through their drills and training, and then they get to Sunday. Well, the only thing that really matters in the end is what the score is on Sunday. It doesn't matter how well you trained, and you know, if you kept yourself in good shape and what you ate and drank and whatever. It's Sunday. And to me, the charts are Sunday. They tell you what people are doing as opposed to what they say they're doing. And to me, that's a world of difference. Now, I will tell you this, okay? Just as there are many, let's call it sloppy or dare I say, ignorant fundamental analysts, same with technical. And you know, we won't have enough time today, but I'll simply say, looking at a chart is not just looking at a chart, and it is not as simple as an algorithm. It is accumulated experience. It is multiple time frames. And at the end of the day, it is not about picking what is gonna go up or gonna go down. To me, it's all about evaluating the following, okay? I believe that any investment at any time has a chance to make money. It doesn't matter if it's a cryptocurrency you never heard of, okay, that was invented as a joke, all the way to you know, Apple common stock, okay? Any of those things can go up at any time, anywhere. The difference between investments A, B, C, D, E is how much risk of major loss is attached at that moment. And that is how I chart.
Okay.
So if you will, it's from a sense of first avoid the big loss. And once you take that off the table, that's what I call risk management, avoid big loss, and then try to make as much as you can. And again, the technique is something that would take a different conversation, and you know,
Right.
Sungardeninvestment.com,
No doubt.
we
No
do
doubt.
a lot of that, so.
Right. And so when I challenge you on charts, it's not because I don't believe in them. I use point and figure charts. I like to use charts. And so the question I then ask you is, when you do your investment homework and you make a decision and you decide to put a trade on, do you believe in stop losses, or do you double down when things go against you?
So that is an awesome question, Jordan. And here's why. It was an awesome question 5 years ago. It was an even more awesome question a year ago. It's the most awesome question of 2022 for those of us who are professional investors, because I believe that where our industry, and I think this is the influence of just so many people being in it, okay? Again, I'll go back to a sports analogy. I'm a team sports guy, obviously, from everything, all the analogies. So when you are looking at an investment, you have to look at two things. You have to look at that investment, and then you have to look at how it impacts the overall portfolio. And what you and I do have in common, okay? See, I use fundamentals and quantitative analysis as a screening tool to define a universe that is limited for that moment in time, the things that I am willing to invest in at the right price. And then the technicals take over. It's only when I refresh the fundamental quantitative list, that it makes sense. So when I am making any decision, I am, of course, I'm looking for things that have a low probability of big loss and have upside potential. The sooner the better, but if it takes longer and it's a steadier chart pattern, that's great too. But what goes into a portfolio is what works best alongside all of its investment buddies in the portfolio, in the same way that, if you don't mind a quick baseball analogy, okay, Mike Trout might be, who's a Jersey guy, might be the best player in baseball, maybe for the last decade, hadn't won a championship. Why? Because he was the star of the portfolio, but there wasn't enough around it, and they didn't make the moves over the years to put enough around him to make it happen. So that, to me, there is so much focus on what I would call bottom-up investing right now. And I have no problem with bottom-up investing, but if there's bottom-up investing without a top-down framework and looking at a portfolio as an ongoing team performing for you, then I don't have much in common with that.
Okay. And so, we definitely do things differently. There's a lot of commonality in there. I'll say again, just for fun, you didn't answer the question, Rob. Do you get stopped out, or do you double down?
Sure. So I don't use stops. You're saying if something goes down?
So I think, look, we both know the answer. I think what happens is the chart's going to turn real negative. And when the chart maybe turns negative, you probably do as well, I'm guessing.
Well, so this is where timeframes come in. And with every investment, I look at it over, I track 12 different timeframes, everything from 1 minute.
12 timeframes. Wow.
12 timeframes. Yeah.
Okay.
Now, I'm not saying I use 12 timeframes. Okay. A quick primer on timeframes and charting for at least from Rob Isbitts for your audience. Okay. There's a lot of different timeframes. To me, the real truth is in the weekly.
Weekly. Okay.
The weekly. Okay. The daily can be helpful. The monthly is good, but you can't pay too much attention to it because, it turns like a oil tanker. But when you get down, when I have decided that something works on the weekly and the daily, or I might not even get to the weekly because it's a shorter term trade, it's more tactical, and I'm a tactical manager. But once you get through the daily, okay, what you're looking for, at least what I'm looking for, is I want to see 4 hour, I want to see 2 hour, I even want to see an hour and 30 minutes.
As an advisor. Okay.
When I'm ready. In other words, once I've decided I'm going to buy something or sell something, I have zeroed down to, am I going to do it this week? Then am I going to do it this day? And then especially with the volatility we've had, an hourly chart moves like, a weekly chart used to sometimes. So it all comes down to having that, it's one thing to say, I'm going to buy this. It's another to say, I'm going to buy it in this price range. And then the final is, I'm going to buy it at this price right now. And so that, to me, is kind of the human, active, tactical version of a stop loss order, because I'm watching it all throughout. But I always have an idea of where I think something can go, where it can't. What is unique about the market in 2022, as I have written in your audience, I believe this year more than any, technicals have failed in places they used to succeed. And that's why amateur technicians are probably scratching their head and they should just try something else.
I find that interesting. It's an interesting comment. So we're going to have to move along, Rob. The conversation is interesting enough that, we'll have you on again and we could really dig a little bit deeper on that. And before I go to where I want to go, I always like to kid that if you don't like the chart, you could change the time frame and find, and if you look at the charts enough time, you're going to find that same exact instrument has the setup you're looking for if you're predisposed to looking for something. So, I hope, and again, I know your dad taught you right, because what we said in the top of the show, there are people, Rob, as you know, that take the same newspaper and look at the new low list first. And there's others that look at the new high list first. And as long as you have an approach, a discipline that works for you, the key is there's a lot of different ways to do things.
Oh, there's no question.
Okay,
No question.
so here's where I really want to go. I have my own opinion on the market, but I didn't ask you to come on the show for that. There's a lot of people talking about a lot of things. And when you're in the industry long enough, you run into people all the time that said, last year I said so-and-so, and I told you that was obvious then, and this was so obvious then. Tell me if and what. There's something that you're looking at, because I'm not that good around looking around the corner. So I know what's making the headlines, but what would you advise both an investor and a trader, but more so an investor? What are you thinking about and realizing right now that's really causing you to take certain actions that's not in the daily news right now?
The era of free money is over, period. Next question.
Okay, well, we can wrap it up.
And it's showing up. It's showing up in the. I mean, it's showing up in the chart patterns. It's been leading to this for the longest time. And by the way, one other thing, just why am I a bigger believer in technical analysis than I was maybe even 20 years ago, even 10 years ago? Because now it's not a bunch of people like me that were considered voodoo artists back in the day. It's what the algorithms are looking at. It's what they're following. And so I believe that you risk being an uninformed investor if you don't at least understand what the charts are saying. The market always tells us a story. The problem with most investors, we don't listen. And I think you and I are the exception to that. And I guess the other thing I'd add to that is, you make money on what you think you know. You lose money when you find out after the fact that there was something that you didn't know. And to me, the charts help you from another dimension, just like value engine equity ratings help from another angle.
Excellent, excellent. So you know what? I think it's a great discussion, Rob. I really appreciate you joining us. And what I like the fact, to summarizing, is that you'll take fundamentals and include them maybe to create the watch list and then work off technicals. I know people that say, please, before you show me a chart, cover up the name so I don't know what it is. I just want to look at the chart. And I think that those people might be working with half a full tank anyway.
You are talking about 2022 first quarter commodity sector, because that's exactly what happened. And if all you did was look at the chart and not look at what was going on around us and in the commodity sector and how rare some of those moves were, then you got bludgeoned, and you just didn't need to. It was what you didn't know. There's no such thing as technicals without context.
Right. So one reason, Rob, I know you're smarter than I am, is you're down in sunny Florida, and I'm still up in the Northeast. So I know you're smarter than I am, and that's a given. But I really want to thank you for joining us. And it's Rob Isbitts. It's the founder and it's the Chief Investment Strategist of Sungarden Investment Publishing. And I knew I'd get that right. And we really look forward to you joining us again. Thanks for the time today.
Thank you, Jordan.